This podcast is brought to you by Business Radio, powered by Wharton, originally airing on SiriusXM.
Welcome to our Behind the Markets podcast. I'm your host, Jeremy Schwartz. Alongside Wharton Finance Professor Jeremy Siegel, we tackle the latest market trends every week on Business Radio, powered by the Wharton School, SiriusXM, Channel 132. Our guest consists of experts like the world's leading authority on long-term economic growth, Bob Gordon.
We will continue to see jobs created rather than destroyed.
Former chair of the Federal Reserve, Janet Yellen.
I don't think either of us ever expected that we would live through a financial crisis.
Or even the head of the Digital India Foundation, Arvind Gupta.
The reason that people are talking about India is massive digitization and financial inclusion that we have done over the last couple of years.
Enjoy this week's show. Welcome to Behind the Markets here in Business Radio, powered by the Wharton School. I'm your host, Jeremy Schwartz, Global Head of Research at WisdomTree. My co-host is Wharton Finance Professor Jeremy Siegel, author of Stocks for Long Run and The Future for Investors. Joining me in the studio today is two of my colleagues, Liqian Ren, the Director of Modern Alpha at WisdomTree, and also Guarav Sinha, Associate Director of Modern Alpha and Asset Allocation at WisdomTree. Guarav and I are both registered representatives for Side Fund Services. Professor Siegel is a senior advisor to WisdomTree. The discussion is not tied to the offer of investment products, and the views of our guests are their own and not those of WisdomTree's affiliates. Professor, lots going on. We got positive tone to the markets here. We've been breaking through some resistance over 2,800. How are you thinking about what's been going on?
Yeah, absolutely. And we've really bounced back on consumer sentiment today. The preliminary data that we got on University of Michigan confirms what we got on the conference board, that the big drop in consumer sentiment was really coincided with the shutdown of the government. Not a good thing. Not a good thing for Trump either, but it's over. And, we've had a bounce back there. Now, the economic numbers are still coming in for the first quarter, which we have 2 more weeks to go, in the low ones. Some people think it might actually be below 1. No one thinks it's going to be below 0, and that it's going to be bouncing back to the low 2s tomorrow. But just the fact that some of the really negative fears that we had earlier have disappeared, I think, is one of the things that is sending the S&P high. Now, actually, it is actually 20. It's about 21, 28, 25 is often what people are talking about as resistance levels. We're at 28, 28 now. So, we would need a really strong day to bring that about. And then it looks where we're only 4% away from an all-time high. Now, I claim that the market's going to be challenged by low increase in earnings. But it is looking at the interest rates of 2.6 on the 10-year with no upward pressure. As you all know, big news next week. We have an FOMC report. Now, of course, there won't be an increase. We know they are, quote, going to be patient. But there's going to be a new dot plot. And, my feeling is their long-run dot plot is too aggressive still. I'm hoping they lower the longer one from 2 3/4 down to 2.5. Because honestly, I think the Fed funds rate should be about 2 right now. It's 2.4. We just were pushing too hard. The market told us that in December and January, and the Fed has laid off, and we're stuck with a kind of a little bit higher than we should be. But that's not anything that should really, substantially derail the economy.
Yeah. So we've heard the point that the earnings growth is going to be one of you're not going to have fantastic earnings growth this year. So if you think about the possible catalysts, are there anything on the horizon that would lead to a more favorable outlook, or how do you think about the dynamics?
Again, I said the market is expecting a resolution of the China. I think, in fact, that's a lot of the strength. I think there will be a pop. But I think that's built into the market. I don't think it's a sustained pop that'll continue to move things higher. Although if we get some, if it exceeds our expectation in the sense that we really do better on protection of technology transfers, and if they lower some of the tariffs on us, in addition, in other words, more than just a cosmetic change, which is obviously what we got with the NAFTA agreement, that could be very positive, and I think would drive the market forward. I would be surprised, but honestly very pleased if we could get something like that.
Very good. Any other comments on interest rates or things around the world?
No, I mean, again, that 10-year, it just shows so much strength. No fears of what's coming. Even with a little bit of the tightening of the labor market that we, actually saw last month, participation still seems to be enough to absorb. That's the key thing. As our monthly employment rate goes on, will we get the participation rising to absorb 200,000 new jobs a month? Can we join the rest of the developed world in actually pushing our participation rate up despite the aging of the labor force? Federal Reserve Chief Powell mentioned that on 60 Minutes last Sunday, that we could do better. We have done a bit better under the Trump administration. If we can do better yet, this expansion can continue to roll. There's no question.
Very good. Thanks for some comments to start us off here.
Thank you very much.
We're going to bring on one of our former co-hosts. He hasn't been on a little while, but is glad to have him back here today. Wes Gray, CEO of AlphaArchitect, on the phone. Wes, you're doing a conference here coming up, sort of the Democratize Quant Conference. It's good to have you to tell us a little bit about, give us a sneak preview of what's coming up for people this week.
Sure, and excited to be back on. And again, sorry I couldn't be in studio, but so the Democratize Quant Conference is really piggybacking on Villanova's academic finance conference. And the basic idea is kind of fulfill our firm mission, and I think some of you guys believe in as well, which is just to try to empower investors through education. And we've modeled this conference off of the academic conference, where traditionally, a practitioner conference is going to have someone go up there and talk about their product, and they're always trying to sell you something, where the concept here is let's have a practitioner actually present an idea, and we'll have an actual debate about it as opposed to a sales pitch. I think it'll be exciting. We've got a gold-plated menu ahead, and I think people learn a lot and have some fun.
Are there panel sessions that you're most looking forward to, things that you've seen the papers, you've seen the debates, what are the big topics of discussion this year?
Yeah, so I think, they're all going to be interesting. I think the first one will be probably one of the most interesting. We've got Ben Johnson from Morningstar and Eric Balchunas from Bloomberg. And the way it's structured is the first person presents, and then the second person is kind of meant to be a little bit antagonistic in the sense that you're not supposed to just agree with the first person. So I think those two are thought leaders in the ETF industry, and they're going to be talking about the future of the ETF landscape. And I think it'll be a good debate of, are we going to go to zero fee for everything? Where are the new products coming from, what have you? Another one that's also, I think, going to be super interesting and probably a little geeky is one by Antti Ilmanen from AQR and Corey Hofstein from Think Newfound. And the topic there is going to be who's on the other side. And the basic question they're trying to address and debate is, okay, you people out there are so smart and you're doing these trades that you tell us work historically, but we want to know who's the quote-unquote dummy on the other side of these trades, and can we identify these individuals or institutions? And on one half of the debate, the answer is yes, but I don't think it's so clear-cut. And I think the most entertaining one, probably going to have the most spark flies and the most intellectual juices get flowing, is one actually Liqian will be debating Jim Kalari on this new asset pricing model called the ZCAPM.
You're putting me on the negative antagonistic side. I need some backup.
Well, hey, I needed someone very smart to debate Jim, who's a pretty distinguished academic professor who's published God knows how many articles.
He's very nice. He's sent me emails or extra materials, but I hope to have a good debate.
I've seen a new side of Liqian as she's preparing, and she's getting her claws ready.
Yeah, no, I think it'll be fun, and and again, the whole spirit of this conference is you almost want to inspire debate and inspire someone that's systematically put in place to say, no, actually, I don't agree with that. Even if they might agree with most of it, you're never really going to learn anything if everyone's just like, yeah, I agree with that. So the conference is going to be structured to kind of inspire disagreement, and hopefully, everyone can get closer to understanding intellectual truth.
Liqian, what's the paper that you're talking about? The 30-second version of what he's trying to say.
It's about return dispersion, and is that an independent, factor from all the factors we've looked at? I think it's very interesting. It's a very interesting paper. The results is a little bit opposite of what somebody else found. So I'm going to have a lot of questions and things to learn.
The question, who's right?
I'm not there to take sides, but to learn. I think that's what the conference is about, right?
Very good. Wes, there's another panel, What's Up with Momentum? You do a lot of work on momentum. I'm sure you have some views on that. Any thoughts on that panel and the discussion there?
Yeah, so that one's, Andy Birkin, he's a PhD, I think, from Caltech or something. So he's obviously, got a way higher IQ than probably everyone in the room. And he's going to be in there, to a certain extent, defending momentum. So I'm probably not the right person to debate him because we're going to probably agree on a lot of things. But I have Tommy Johnson, who's she's a PhD. She writes a lot of times on her blog. And she also somewhat agrees with what Andy's probably going to be saying. But, again, she's in a position to be the person that says, well, what about this and that? So even though she may agree with this idea that, hey, momentum seems to be busted, but, there's probably reasons why, and we still think it can work long term, she's going to be there to tell our Caltech physics PhD that maybe he's wrong. So I think that one will be definitely exciting, and I'm sure a lot of people in the audience will want to interject and, have their own opinions on things. And then the other thing that's going to be cool, it'll be less on the kind of intense research academic debate style, is, towards the end, we have the one panel with you, Jeremy. We're actually going to be interviewing Jim O'Shaughnessy, who's been in our business for, 3 decades now. And, I think that'll be super interesting just to get perspective from someone who's been there and done that 100 times over. And then finally, we're going to end with Annie Duke, who we actually interviewed on the podcast there. She's former famous poker player, published Thinking in Bets. And we actually talked today, this morning. I had a chat with her, and she was going to present originally, but she's like, no, let's do a talk. So now I'm going to actually be interviewing her, and we're going to be talking about how a lot of her insights from that newer book actually apply directly to the financial industry, and how we can take lessons from that to help investors make better decisions.
Yeah, I like her, and I think I saw it on Twitter this week. Somebody talking about her and maybe Mobison, who's written on it, saying, if the difference between skill and luck is, can you lose on purpose? And you think about these factor strategies, can you lose on purpose and design a strategy that's designed to lose? And if not, then that is somewhat skill. You're if you can't do that.
Yeah, no, for sure. And so we'll be talking that. And then one of the things that I thought she wanted to do, which I think is a good idea, is she's talked so much about the book, and obviously people can go read it, but she really wanted to angle on doing some things that are outside of the actual book. So I don't want to release all the secrets here because I don't want to break her party. But so hopefully that conversation will be insightful to those who are Annie Duke fans and who have read the book 20 times like all of us have. So I'm excited about that, and I think it'll be a great way to end the event.
And how do people get involved for next year? They hear about it a little bit now this year on our podcast. How do they get involved?
Yep. So one of the issues is the event, at least as it currently stands, is capacity constrained, which just the nature of we're partnered up with Villanova, and they can't take on hundreds of people, and so we maxed the capacity up to 100 this year. We'll talk about it, but it certainly seems like there's huge demand for this, because we've already had to turn away plenty of people. So hopefully next year we can, expand the footprint and allow more folks to go. But one of the things we are going to try to do this year is we're going to try to videotape a lot of the, kind of key points and do some follow-on interviews and hopefully kind of create a package where it's like the highlights from the event. So, someone who's unable to attend can at least, gain some insights from, from the knowledge that's being shared there, even though we unfortunately just don't have capacity to accommodate everybody.
Understood. Well, thanks for coming, giving us a quick preview. We want to get you back in the studio here soon. Thanks for coming on and sharing some.
Yeah, you got it. And, look forward to get back down there. I just need to stop working so hard and going back down there and having some fun with you and the crew.
Very good. We've been talking with Wes Gray, CEO of AlphaArchitect. I'm Jeremy Schwartz. In the studio, we have Liqian Ren, the director of Modern Alpha, Guarav Sinha. Guarav, you just came. I wanted you to come on. You came back from a trip to India. India's been in the news a lot. There's been a lot going on, a lot of geopolitics. There's a big election coming up. It had been one of the big laggards in emerging markets, but it's sort of revitalized recently. So just want you to come back and share some views as you're very close to that.
Yeah, of course, and thanks for having me on the show, Jer. But essentially, I've been living in New York since 2008, so almost 11 years. And when we live in a Western hemisphere in a developed country, it's hard to see there are not many changes on the ground. It's pretty much same as it was 10 years ago. So when you travel to a country like India, after every 1 or 2 years, things are hard to recognize because they change so fast. 2010, when I first went to India after being in the US, Delhi was connected through state-of-the-art subway system. You can even check your baggage, and that gets directly to an airport, to an airline, and you don't have to come to a terminal. That was a big change. 2012, when I went there, it was a smartphone revolution where everybody had smartphones, and not exactly iPhones, but something of which is cheaper version of iPhone, but still it was a smartphone. 2014, it was essentially retail stores and supermarkets popping up. Now, India is traditionally like little, markets and bazaars, but now you had like big luxury retail stores. 2017, it was airports in like smaller cities and a lot of domestic airlines connecting bigger cities to smaller cities. So the point that I'm trying to make is that India as a country is actually growing a lot faster, and you see these changes on the ground. Beyond just the noise of financial markets, it's really heartening for me to see that when you travel on the ground, you see all these changes happening, which are a reflection of, the broader changes in the economy and how fast this country is growing.
So what would you say, when you think about what's going on in the markets, where it was in the first few months of the year, one of the laggards, what's changed?
Right. I think, first off, markets never go up in a linear way. There's always a lot of noise around the broader trend. I think the broader trend for India is upwards. However, having said that, there is a little bit of a caveat that I want to put out right up front, is that India is now up due for its general elections. The dates were just announced last week. It's going to be from April 11th. I think April 19th to May 11th, I beg your pardon. And then the results would be announced on May 23rd. Now, this is a truly phenomenal exercise because it's almost 1 billion voters. So that's the largest democratic exercise on this planet anywhere. It's a $7 billion estimated expenses of the election, which is even more than the most expensive elections which we saw with President Trump getting elected. There was $6.5 billion. So this is $7 billion. So it's an election of epic proportions. My sense from being on the ground is that Prime Minister Modi has real good chances of coming back, much more than what he had few months ago. There has been a sudden surge in his popularity back again. But as with any elections are all about arithmetic. And more than anything else, markets hate uncertainty. So for next few months, I think as we run up closer to the final day, there might be a little bit of volatility as the trends and the exit polls and all these, various political analysts throwing out their opinions. But once all the dust is settled, I think India is all set for, long-term growth here, because some of the work that they have done on the ground, now whether it's financial changes, the economic changes, socio-economic changes, bringing everyone in the ambit of, financial broad financial umbrella, all of it is phenomenal. So I think the long-term trend is going to be absolutely, much better than anywhere else we see, broadly speaking, in emerging markets. Having said that, in the near term, I think there might be a little bit of volatility.
Now, you sort of talked briefly that Modi's become more popular, but there was the skirmishes with Pakistan,
right,
and that was one of the things where Modi came very tough.
Right.
Maybe describe, as you saw the sentiment there, I mean, is that one of the things you think is leading to popularity?
Yes, for sure, yes. So after implementing some of these, financial reforms, whether it's goods and services taxes bill, or whether it's demonetization, where he scrapped 86% of floating currency in 2016. All of these implementations, while good for the economy in the long run, actually hit small traders and average person on the street. So therefore, his popularity was kind of declining a little bit. He still continues to be one of the most popular leaders, but people were not happy with all the hard reforms that he had implemented. Now, few months ago, there was this terrorist attack in India, and unlike a lot of previous leadership, Modi came out and used this to an extent as an opportunity to not just reply back and face the problem of terrorism, which has really become a global problem right now, but also it comes at an opportune time for him because it's an election season. So he didn't want to be seen as a soft leader. So he took like a real tough stand, and it played out well for him. So the narrative from, talking about how the reforms have affected a normal person on the street has now shifted to more towards national security and, how we need like a strong, tough leadership. So it's definitely going to help Modi. The question is like, can opposition change the narrative back to economy and then, the unhappiness on the street with the inconvenience that people are having. For the moment, he seems to be back in the game again.
Now, which one were you going to jump in?
Actually, I do have a question. So I know that in China, the state sector and the non-state-owned sector is pretty different, mainly because, the state is indeed very controlling. So from your India point of view, like, are they also a different way of investing in India?
No, I think this is a problem across emerging markets that you have like two investment choices, whether you want to invest in state-owned or market cap weighted or ex-state-owned. I think it's a bit more amplified in case of China because a lot of things are state-controlled and like 50% of Chinese market cap is state-controlled shops, state-controlled companies. In case of India, it is there, but to a much more subdued extent. Firms in India have a sovereign risk for sure. If something happens to the currency, to the government, or the political, economic policy making, that's going to impact companies for sure. But the state ownership of listed companies in India is not as high. So, having said that, I would say that as with any other emerging markets, ex-state-owned exposure in India is much better than a state-owned exposure. And this is especially true for financial sector because 75% of assets in financial sector in India are essentially state-owned banks. So within financial sector, it's a bit more amplified in India. India compared to a lot of other EM countries, whether China, Brazil, is less state-owned, but that is a general problem, I would say, across emerging markets.
Okay.
Now, Gaurav, when you do, in addition to focusing on India for us, you do a lot of work on asset allocation,
right,
dynamic asset allocation, and you've done some different modeling on different risk-on and risk-off triggers on how do you look at the markets. Do you want to sort of describe some of that process, and then we can talk about what some of the models talk about today?
Right. So this goes back on to some of the research I was doing to how financial markets have changed in a post-quantitative easing world. And essentially what we found out was that after financial crisis, every time markets started going down, average correlations in a given asset. So if you're talking about U.S. equities, then within U.S. equities, average correlations, they kind of shot up. And then the Federal Reserves came out with the first QE1, and then immediately correlations relaxed and markets jumped up. This trend kind of repeated every time when there were three respective QEs, and even in a post-QE world, correlations have been kind of rising, and markets immediately afterwards have experienced a higher volatility. So there seems to be a link between assets getting highly correlated and then that feeding into higher volatility in following months. So that's the basic framework on which I'm trying to build a systematic approach to asset allocation, where you look across assets. What are the assets that are showing unusual signs in their average correlations? And if there is a higher unexpected jump in that number, then that probably is an asset class which is flashing red. And as a conservative to moderate investor, you want to be hedged out in that asset class. It's something similar to saying that you want to be swimming in a turbulent water. If there's a lot of turbulence in a given river, you don't want to be jumping into it and swimming into that. So as a global asset allocator, we are using correlations as a first set of signals to identify risk on and risk off in different asset classes. And then you overlay it with second or third set of indicators respective to that asset class. So within equities, it could be equity-specific indicators like momentum, volatility, and some other factors. For fixed income, it could be some other factors, so credit spreads and shape of the yield curve. So the first set of indicator, which is the correlation, tells you whether it's a bullish or a bearish outlook, and the second and third set of indicators tells you how much overweight or underweight you want to be. And the second and third set of indicators are more linked to the asset class, that we are working on.
So that's a good general preview of that. So now when you look at this, where does that signal stand in March? Like how coming into March, how did it look like from an asset class perspective? I've been tracking that signal on a live basis starting January 2018. So for entire last year, we have been, I've been tracking it for across equity markets. I saw a massive spike in near-term correlations in U.S. equities in January 2018. And that essentially meant that there is something unusual happening within U.S. equities, and there's a high systematic risk in the equities. So February 2018 is when we saw the massive spike in VIX, where on Feb 5th, VIX jumped by 100%. By the way, this is an unusual event because it had never jumped before in its history of 30 years by 100%. So we were hedged out for the month of February, March, April. Then we went back in market again in May. And then we hedged out again in October 12th. So we again avoided the almost entire Q4 market correction that happened in 2018. So it played out really well last year. We avoided, if I would have been following this strategy on a live basis, we would have avoided a lot of market correction. Going into March, coming back to your question for this year, it seems to be a risk on for most assets except for small caps in general. So US small caps, it was hedged, or it was showing a higher risk sentiments for US small caps, for EFI small caps, and for Japan large cap equities. So those were the only three portions of the global equity markets where it was showing bit higher risk compared to everything else. And so when you think about these kind of models, I mean, certainly there's no indexes that we have live today that are doing that, but you're thinking about that as a custom dynamic allocation for people who are looking at different risk on, risk off signals. It's something that people can talk to you about.
Yeah, of course. I think this is a sort of an attempt to quantify an asset allocation decision. You can overlay this quantitative approach with a qualitative overlay. In my opinion, this tends to work a bit better for tactical asset allocation framework because these signals can change quickly with more recent developments in markets. But nobody can claim that they have the best model that works under all circumstances. So I would, of course, try to overlay the quantitative framework with a qualitative overlay and use it more for tactical asset allocation as of now. Now, there's a lot more research that we need to do to make sure that if we go strategic, then do we need to adapt the same framework and tone down the frequency so it also works for low frequency asset allocation as well, as it has been working exceptionally well for a higher frequency or a tactical asset allocation.
Yeah, in that tactical world, I mean, I know a lot of the trend following approaches, there's a lot of moving average signals and things that cross over, cross under. and those get whipsawed quite often. I think that's what happened at the end of last year. Some of those moving average risk-on, risk-off signals got out right after the fall and then struggled to get back in. And so it's an interesting alternative to some of the traditional ways people look at that risk signal.
If I can just add on to Jer, one quick comment on that. The problem with a lot of these technical signals is that they tend to be concurrent. Momentum goes up when market goes up. Volatility goes up when market goes down. The real genius of a signal is if you can have some sort of a forward-looking guidance, right? So with correlations, what I've found is that correlations going up does not immediately implies that market is going to go down next month. However, what it does imply that if at all market goes down, then you would have less places to rotate because everything is highly correlated within themselves. So stock selection would become much more difficult in a highly correlated environment. So you're better off doing asset allocation than stock selection when assets are highly correlated. So when these correlations are going up, that's a signal for you that you got to be more smarter with your asset allocation and emphasize less on stock selection. And how do you do asset allocation? Either by implementing a hedging strategy or by bringing in something that reduces your market beta. That's the way to go about it. So the key is that finding signals that have some sort of a forward guidance and then switching between asset allocation and stock selection, overweighting which technique more over the other. That's what I'm trying to still explore and see if we are heading in the right direction or not. It seems to be working really well for last year. We'll see for future.
Yeah, no, it's one of the more interesting signals that I see and follow. So thanks for all that and that background.
I'm Liqian Ran, Director of Modern Alpha at WisdomTree, and you're listening to the Behind the Markets podcast. Our show airs live every Friday, 1 p.m. Eastern Time on Sirius XM, channel 132.
Talking with Jay Hatfield, founder, portfolio manager, CEO of InfraCap, an investment advisor who manages exchange-traded funds, series of hedge funds. And Jay holds an MBA in finance from the Wharton School. So glad to talk to another Wharton guy, Jay. Thanks for coming on our program.
Thanks, Jeremy. Thanks for having me.
Tell us a little bit about your firm and how you got started to found the firm.
Well, I was working at SAC Capital as a portfolio manager doing MLPs and credit there, and left with some seed funding from Steve Cohen to launch some hedge funds, but that was in 2008, and so the markets were disrupted in terms of raising new capital, except for companies. So a friend of mine, Mike Krimble, who was the founder of Energy Transfer Partners, and I started to work on launching an MLP. And we successfully got that public a couple of years later. That's NGL. And he's running that company in Tulsa. And then after that, we formed the advisor and then launched our first, we had a couple of hedge funds, launched our first MLP fund, and then a couple of credit funds we launched a couple of years ago. So that was the genesis of the firm.
And so how do you think, so you've done the wide spectrum from hedge funds to sort of exchange-traded funds and the individual MLPs. Like, how do you think about the opportunity size, where you're, the different reasons to go after each market there?
Well, when it comes to mutual funds and interacting with advisors and retail, we try to be 100% income-focused. We think that too many retail investors get caught up in the kind of casino mentality of the stock market and don't focus on the fact that almost all companies are cash flow positive and many pay significant dividends, and you can invest in fixed income. And you can construct portfolios that have reasonable risk and good cash returns, and where you can be long-term focused and just reallocate, quarterly or what have you. So that's what we try to be 100% focused on on the mutual fund business, which is really our key focus right now. On the hedge fund business, I guess we implicitly agree with Guarav that a critical element is market timing and being long when the market's going up and not very long when it's highly volatile and correlated. So we tend to be pretty opportunistic in our hedge funds in terms of putting on exposure and taking it off, which of course we don't do. as much. We run a little bit of leverage, so we will take our leverage down, but we don't. Obviously, people are looking for the exposure, so they don't want mutual funds to go to 100% cash by any means.
Yeah. And in terms of the MLP space in general and the energy opportunity set, like how are you thinking about the developments, at a high level, to sort of talk about the development in that market and where you see these sort of opportunities?
Well, we're pretty bullish about oil, generally speaking. People kind of forget that it has beta, so they always, when it went down last quarter, they kind of assumed it was Armageddon. But, it does have pretty significant sensitivities to demand and supply. So there's really pretty little chance that WTI will be significantly below 50. The reason for that is strong U.S. sensitivity to price. So we're seeing that now where there's pretty strong demand for gasoline as we head into the driving season. And then, of course, probably a little bit more importantly, OPEC was overproducing last quarter, really somewhat at the behest of the U.S. administration to offset the sanctions against Iran. And now they're cutting back production and inventories are coming down. So we're pretty bullish about oil. And also, even though it shouldn't really occur because the market's supposed to be efficient, normally energy stocks do better as we head into the driving season. So they normally do well in the second and third quarter. So we see that kind of unfolding now where we're about to head into the spring driving season. Energy stocks are pretty depressed and market stable. So we're pretty bullish about the sector. And then, of course, the U.S. is the lowest cost marginal producer of oil. So we're bullish about volumes in the U.S., which will be good for infrastructure / MLP companies and refiners. So I think it's setting up pretty well after being dislocated last quarter after the crash or significant market decline.
How do you think about the sort of beta of the MLPs to oil? I mean, there are a lot of people who said, they're not tied to the oil price at all. They're this sort of very, they sort of have contracts. They're not tied to the oil price. I mean, how do you think about that beta to oil of the sort of pipelines and the infrastructure?
Well, their non-correlation to oil was really overstated.
Yeah.
And there's two places it showed up. First of all, it's declined over time, but 5 years ago or 4 years ago, I guess, when the oil market crashed, most larger MLPs probably had 10 to 20% direct exposure to commodities. That's declined now. Partly just it got wiped out, number one, and then number two, they've hedged it or changed their contracts. But most importantly, though, a lot of people use the toll road analogy, which I never really loved, but it's kind of appropriate in that when you say toll road, a lot of us live near 95, so we say, oh my God, that's low risk. But of course, you need traffic, and there are toll roads that go bankrupt because they don't have adequate traffic. So what happened to the MLPs is they're not really super commodity sensitive within a band. So if oil had gone from 100 to 90, they would have been fine. But when it went to 20 or close to that, volumes dropped dramatically. So the traffic on the toll roads, if you will, if you want to use that analogy, dropped. And the companies didn't lose all their cash flow, but it became a big headwind. And then they had to, and their marketing businesses became, lost all their margin. And then, contracts started to roll off, and they had to recontract at lower prices. So it became a big headwind. Now, though, there's a big tailwind because there's much higher volumes, and the companies are restructured. So now they're actually in good to great position, yet investors haven't really come around to it yet for obvious reasons because it's been a long 5 years of declining volumes and restructuring.
And how would you think about, if you're talking to clients about just the opportunity in the MLP space generally, like how would you say it compares to other areas, things that you're sort of excited about in the income markets? How do you?
Well, it's a little bit. It sort of has two elements to it. First of all, it is in our model showed being pretty significantly undervalued, whereas probably REITs and utilities are pretty fully valued. But we are bullish about interest rates, so they're probably going to be fine. So we think there's a pretty significant opportunity, but we always recommend that investors undersize MLP allocations because they are significantly, even though they have high income, they do have high betas. So they're correlated to energy and energy to oil, rather, and oil is highly correlated to the stock market. So should really assume, a beta of 1 or even higher in a market decline. So if you're 5% in utilities, we always recommend people being 2.5 in MLPs or less, and dollar cost averaging, because it is a volatile asset class. But we think that it's on the efficient frontier from an allocation perspective if you want income. And so we recommend, undersized positions in MLPs.
Let me just reintroduce our guest here. We're talking with Jay Hatfield, founder, CEO, portfolio manager at InfraCap, investment advisor focused on MLPs and other sort of income-oriented securities. Liqian, you want to jump in here?
Hi, Jay. I actually don't know this space very well. So in terms of MLP, I only heard very little. Is it like the tax advantage used to be very high, but there are some changes in tax law that might make it a little bit less? And how do you guys, work around that?
Well, the taxation is complex. I have a friend who works at the IRS who said that partnership taxation is the most complicated tax area, at least in the United States. But so there's sort of two elements to that. There was a FERC ruling that limited some deduction of corporate income taxes in rate cases, but then that was relaxed, and then most of the companies were able to structure around that, either convert to a corporation for a few of them or just go through a rate case, because rate cases are complicated. So there's kind of that FERC issue, which I don't think is that material right now. The second thing that was made MLPs less attractive on a relative basis a little bit is just the corporate tax rate going from 35 to 21, but there is still partnership pass-through. And then from our perspective, though, it was mildly positive because our MLP funds structured as a corporation, so we actually benefited from that drop. So it's actually pretty complicated. What investors should know is if they do buy the stocks individually versus through some of the ETFs, then you will get what's called a K1, the partnership return. Unless you have a tax preparer and fairly complicated tax return, that's likely to cost you extra for the preparation of your tax return and add significant complexity to your tax return.
Hey Jay, this is Guarav. So I'm also not an expert on this space, but from what I read and hear, we as a country have been becoming so much energy efficient, and every time you see like new alternative energy companies coming up. And so generally speaking, like, do you see alternative energy as a potential competitor for the traditional energy, and more specifically, how does it impacts MLPs in the long run?
I wish that were true. I started working on renewables about 30 years ago when I was at Morgan Stanley. Mm-hmm. And did some of the first financings. But the problem is just that the penetration rate is slow. Obviously, that was a long time ago, and they're still relatively low. And so, also the geography can be challenging. Like in the East, it's much more difficult to site wind and solar than it is in the West. Wind is quite a nuisance for residential areas. So we think there'll be continued penetration on that side. But and in fact, that's actually kind of required, though, in the sense that, the global economy on a nominal basis probably growing still about 3 or 4%, mostly driven by the U.S., but energy demand for oil is only going up by about 1%. So you actually even need all of those efficiencies, LEDs and others, just to keep the energy intensity dropping over time, and so we don't have skyrocketing demand. We actually have pretty relatively sluggish demand. A lot of actually is driven by, your area of expertise, like India and China, where penetration of automobiles is rising. Again, slowed down by the fact that, particularly in China, a lot of them are going to be electric, but still the penetration rates are a fraction order of magnitude less than they are in the U.S., so that's still driving net demand, and I guess most people don't think we'll have peak oil demand for 20 or 30 years, close to when we have peak population.
Right. And another buzzword these days is electric cars. Do you think electric cars may have some sort of an impact?
Yes, of course. At the margin, those are going to help our energy intensity. What a lot of people forget is that electric cars use electricity, and electricity uses right now at least primarily natural gas. And the other thing that people forget is that probably the lowest hanging fruit would be to eliminate coal-fired electricity. And of course, U.S. MLPs don't. There's only one, and we don't invest in it. Don't traffic in coal. So the first thing that should be done, really, and should be focused on, which is unfortunate it hasn't been, Bloomberg has, but is to eliminate coal-fired generation, because it's not only bad from a CO2 perspective, but horrific in terms of mercury and SOx and NOx. So it's just a really social negative. And so that's still about 35% of U.S. generation. So that has to go away. And it's most likely to be replaced by a little bit of renewables, but more natural gas. So there's not a lot of scenarios where not all carbon-based fuels, but certainly natural gas and oil continue to slow demand growth over the next 20 years.
We're talking with Jay Hatfield, who is the founder, CEO of InfraCap. And Jay, so I know you guys focus on, beyond MLPs, you also focus on other higher income securities and the preferred space. Maybe sort of talk about the way the traditional preferred indexes have been established and sort of some of the different ways that you think about that space.
Well, we focus on, we like listed securities because they're lower risk when it comes to market downturns, because the liquidity usually drops. I used to trade high yield, and since you're trading with Wall Street and they're under pressure in down markets, then the liquidity will drop. So we prefer the listed $25 preferred space, and we think that can be quite attractive. The only issue with a passive fund that tracks preferreds is that a lot of them don't have any features that deal with the call provision. So retail $25 preferreds are callable at par. It's 25 after 5 years. And so that's one reason. One solution is to have active management and to deal with that. So when we look at preferreds, we always look at the yield to call. And that way you don't end up buying securities that are trading significantly above par, callable at par.
And there's, the preferreds tend to be concentrated in a few particular industries. Like, is there a group, the sort of REIT preferred is an example of one that you think is sort of special versus the general preferred part of the market?
Yeah, we think that REIT preferreds are generally good full cycle credits because they are structured to not have significant leverage. The investment banks sort of got burned, this is years ago, 30 or 40 years ago when REITs first came out and they had too much leverage. So they typically required the companies to have modest leverage, like 40%. And when you're 40% levered, that means that there's pretty significant excess leverage capacity in your real estate. So oftentimes those companies will have unlevered real estate, and then the preferreds, in effect, become sort of the first creditor calling on that. So we think those are good full cycle investments. Also, MLPs are increasingly issuing preferreds, and we think those are good credits and usually trade at pretty wide spreads. And also mortgage REITs, too, seem to have wide spreads that are above, what we would judge as their credit risk, partly just because the common yield so much that retail investors demand more from the preferreds. So we think there's a lot of opportunities for investors or for active managers to seek out, good risk-return trade-offs in the preferreds. What we don't like, though, is we don't like distressed preferred investing. So we want good to great credits because in bankruptcy, preferreds are dealt with, they're junior securities, they're stocks, so they could often be wiped out. If you're going to do distress, it should be secured, senior secured.
And what is the total size of that REIT preferred market? When you think about the opportunity for people and how to compare it, size it, you mentioned sort of sizing MLPs, maybe half of a traditional utilities allocation. When you think about real estate, I think if you looked at like the S&P 500, maybe it's 3% of the S&P 500 tends to be in the real estate sector. How would you think about the preferred element?
It's liquid and growing. It's about $150 billion, but it is growing pretty substantially. Because REITs do, from a credit perspective, do get a lot of credit from the rating agencies for issuing preferred. And they do like to, since they're dealing with relatively thin margins and low cap rates, that can make the difference between, an economic project versus an uneconomic project. So we think that's going to continue to grow. So we think it's continued to be a robust sector for preferred issuance.
And any commentary on the industry generally, like where you're investing your time beyond these sort of areas that we talked about today?
Well, we continue to be pretty bullish about interest rates. Not so much that treasuries are a great buy, but that they're range bound, and that's something if you're going to invest in preferreds, you really need to focus on because they are almost all of them are perpetual, so they effectively get priced off 30-year. And so, they have a little bit of interest rate risk, a little bit of credit risk, but you have to be cognizant of that interest rate risk. So we think that we're range bound. We've thought that for a while. And so if we're correct about that, then preferreds would be an attractive asset class to look at. And they do have some tax advantages. A lot of the dividends end up being qualified, and REIT preferred dividends get some tax breaks, and some MLP dividends get tax breaks. So we think it's an attractive sector for investors to look at, either on their own or through ETFs.
Very good. We've been talking with Jay Hatfield, founder, portfolio manager, CEO of InfraCap, an investment advisor who manages exchange-traded funds, series of hedge funds. Jay, thank you so much for joining us on the conversation today.
Thanks, Jeremy, for having me. I appreciate it.
You've been listening to Behind the Markets on SiriusXM 132. I'm Jeremy Schwartz. Thanks to Liqian Ren, Director of Modern Alpha, Guarav Sinha, Associate Director of Modern Alpha and Asset Allocation here at Wisdom Tree. You can listen to us at Behind the Markets Podcast. Have a great week, everybody. Thanks for listening to the Behind the Markets Podcast. If you want to learn more about Wisdom Tree, visit wisdomtree.com. You can also follow me on Twitter at Jeremy D. Schwartz. I'd like to thank Patty Hall for producing our live program on SiriusXM Channel 132 and our podcast producer, Daniel Bruno. Join us next week for another edition of the show.
For more insight from Business Radio, please visit businessradio.wharton.upenn.edu.